Something unusual happened in the early morning hours of Monday, January 19th, 2026, though almost nobody noticed it at the time. The International Monetary Fund quietly released its January World Economic Outlook update, and buried within its carefully hedged language was a number that, once properly understood, carries implications far more significant than the headline growth figure of 3.1% that news outlets briefly mentioned before moving on to the next story. The actual substance lies not in that single figure, but in what the report calls downside risks, a term of art in institutional finance that describes the gap between what appears stable on paper and what is actually straining beneath the surface. The IMF noted that global growth is projected to slow from 3.3% in 2024 to 3.2% in 2025 and 3.1% in 2026, with advanced economies growing around 1.5% and emerging market and developing economies just above 4%. These numbers, presented with the bureaucratic calm that characterizes all official communications, conceal a more troubling reality. What the fund is actually describing is a trajectory that, when placed alongside historical data, reveals a pattern that serious analysts recognize immediately as the mathematical signature of systemic stress. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. What follows is an attempt to explain why certain outcomes become structurally inevitable once specific conditions align, and why those conditions appear to be aligning now in ways that few observers seem willing to discuss openly. To understand what the IMF is actually warning about, you must first understand what a growth number of 3.1% means in the context of a global economy carrying $38 trillion in United States federal debt alone, with interest payments that now exceed $1 trillion annually, and a Chinese real estate sector that has contracted between 50 and 80% from its 2021 peaks, depending on which metric you examine. The headline figure masks a divergence that matters enormously. Advanced economies are projected to grow at just 1.5%, which is below the historical average of 2.4% recorded between 2000 and 2019. When you strip away the statistical smoothing, what emerges is a picture of developed nations collectively decelerating while simultaneously facing debt servicing costs that are accelerating. This is the mathematical definition of unsustainability, and yet it receives almost no attention in mainstream financial coverage because the implications are uncomfortable. The World Bank released its own Global Economic Prospects report just 6 days before the IMF update on January 13th, and its conclusions reinforce the same structural concerns. The bank noted that if current forecasts hold, the 2020s are on track to be the weakest decade for global growth since the 1960s. Consider what that statement actually means. We are living through a period of growth stagnation that rivals the aftermath of the Kennedy assassination, the Vietnam War buildup, and the early stirrings of the stagflation that would define the 1970s. And yet asset prices in many markets remain at levels last seen during the dot-com bubble, when the cyclically adjusted price-to-earnings ratio for the United States market exceeded 40 for the first time since the crash of 1929. That ratio sits near 39 today. The Bank of England has warned explicitly of growing risks of a global market correction due to possible overvaluation of leading technology firms, with OpenAI's valuation more than tripling from $157 billion in October 2024 to $500 billion the following year. The question serious analysts ask is not whether a correction will occur, but rather how the correction will interact with the other structural fragilities that have been building for years. This brings us to the debt situation in the United States, which has entered a phase that former Treasury Secretary Janet Yellen recently described using language that invoked the Roman Empire's policy of currency debasement. The United States began 2026 with a debt-to-GDP ratio of approximately 120%, a threshold that for most nations represents what economists call a game changer in terms of bond market influence over domestic policy. Interest payments on the national debt hit $1.21 trillion in fiscal year 2025, consuming 17% of total federal spending, which is more than the entire defense budget. The average interest rate paid on this debt has doubled from 1.61% in 2021 to 3.36% in 2025, and with $38 trillion in outstanding obligations, every quarter% rate increase adds $95 billion annually in interest costs. What makes this situation structurally different from previous periods of elevated debt is the combination of factors now converging. Treasury Secretary Bessent acknowledged publicly in June of 2025 that long-term debt issuance made no economic sense given that rates were more than one standard deviation above long-term averages, and that the time to lock in cheap financing would have been in 2021 or 2022. This admission, delivered with the understatement typical of Treasury officials, describes a trap. The government missed its window to refinance at favorable rates and is now rolling approximately $9.2 trillion in maturing debt annually, roughly 25% of the entire national debt, in a market environment where foreign appetite for treasuries is declining, and where the traditional buyers have shifted their behavior in ways that indicate diminished confidence in dollar-denominated assets as long-term stores of value. China's Treasury holdings fell to $730.7 billion in July 2025, down from $901.7 billion in September 2022, a 19% reduction over 3 years. More significantly, gold reserves held by foreign central banks have now surpassed Treasury holdings for the first time since 1996. This is not a marginal shift. It represents a structural reallocation away from dollar assets that has been building for years, but accelerated markedly over the past 24 months. The nature of foreign buying has also changed qualitatively. Foreign investors now treat treasuries as liquidity tools rather than long-term investments, purchasing short-term bills rather than long-dated bonds. This subtle shift has profound implications because it means that in moments of stress, these holdings can reverse instantly, unlike the sticky sovereign wealth allocations that characterized treasury markets for decades. The domestic side of this equation is equally concerning. The IMF has noted that half of all financial assets worldwide are now held by institutions that are not regulated as banks, including hedge funds, investment funds, insurance companies, and pension funds that have made their fortunes on extremely short-term and highly leveraged positions. These non-bank financial institutions have become the marginal price setters in sovereign debt markets, and their risk management frameworks are designed around liquidity assumptions that may not hold during periods of genuine stress. The 2007 to 2009 financial crisis demonstrated precisely how much risk non-bank institutions can add to an economy, and the subsequent recession required both monetary and fiscal responses that caused further distortions and added to public debt. This is not ancient history. The lessons remain relevant because the structural vulnerabilities have grown larger, not smaller. Meanwhile, the Chinese economy, which has served as a critical engine of global growth for 3 decades, is now contracting in ways that even Beijing's carefully managed statistics cannot entirely conceal. Goldman Sachs research projects Chinese GDP growth of 4.8% for 2026, down from an estimated 5% in 2025. But independent analysts at Rhodium Group argue that actual 2025 growth fell short of 3%, with a strong first half giving way to a badly downsloping second half. China's property sector is in its 5th year of decline. New home starts, sales, and property investment are down 50 to 80% from their 2020 to 2021 peaks. There is no sign of the property market reaching a bottom yet. Real estate development investment fell 15.9% year on year through November 2025, and private investment overall declined 5.3%. The deflationary pressure this creates is structural and self-reinforcing. China has been experiencing deflation in its producer price index for more than 3 years, and consumer confidence remains depressed amid an uncertain employment outlook and eroded household wealth. The labor market indicators show hiring at its most depressed level over the past decade outside of COVID lockdowns, and nominal wage growth slowed to just 3.8% year on year in the third quarter of 2025. When households face stagnant incomes and declining asset values, they reduce consumption, which creates the conditions for further price declines, which erode business profitability, which leads to more layoffs and wage stagnation. This is the deflationary spiral that Japan experienced for decades, and it appears to be establishing itself in China, despite Beijing's policy interventions. What connects these seemingly disparate phenomena, the American debt situation and the Chinese property collapse, and the stretched equity valuations and the IMF's downside risk warnings, is a pattern that historians recognize from previous periods of systemic stress. Large economic systems do not break suddenly in the way most people imagine. They deteriorate gradually through a sequence of decisions that seem rational individually, but become collectively destructive. The United States chose to stimulate its economy through fiscal spending while maintaining elevated interest rates to combat inflation. China chose to sustain manufacturing output through exports while domestic demand remained depressed. Investors chose to concentrate their holdings in technology companies whose valuations depend on AI spending continuing indefinitely. Each choice made sense from a narrow perspective. Together, they have created conditions where multiple stress points are likely to be tested simultaneously. The historical parallels are instructive without being deterministic. In 1929, the stock market crash came after years of elevated valuations, excessive leverage, and a concentration of wealth that had stretched the consumption patterns of ordinary Americans beyond sustainable limits. In 2008, the crisis emerged from a housing market that had been inflated by financial engineering and regulatory forbearance, combined with levels of leverage in the banking system that left no margin for error. In both cases, the proximate triggers were less important than the structural vulnerabilities they revealed. The actual cause of systemic collapse is never the event that precipitates it, but rather the accumulated imbalances that make the system fragile enough for any event to trigger cascading failures. Today's imbalances are arguably more severe in absolute terms than those that preceded either of those crashes. The S&P 500 currently trades at a forward price-to-earnings multiple of approximately 22, and the CAPE ratio hovers around 39, its highest level since the dot-com bubble. 30% of the S&P 500 and 20% of the MSCI World Index is held by just 5 companies, the greatest concentration in half a century. AI-related capital expenditure now contributes approximately 1.1% of U.S. GDP growth, which means that any reversal in AI spending would remove a substantial portion of economic expansion at precisely the moment when other growth drivers are weakening. The Bank of England has explicitly warned that investors may not be properly cautioned about the risks of a stock market crash if AI falls short of market expectations. The International Monetary Fund has reinforced these concerns. Ray Dalio of Bridgewater Associates has drawn comparisons between current market conditions and the dot-com bubble, describing investment levels that are very similar to that earlier period. The reason most people miss these patterns is not that the information is hidden. It is that the human mind struggles to perceive gradual deterioration when daily fluctuations dominate attention. We are cognitively wired to notice sudden changes and discount slow trends. This is why economic collapses feel sudden, even when they are actually the culmination of processes that unfolded over years. The person who loses their job in a recession experiences it as an acute event, but the macroeconomic conditions that made that job loss probable were established long before the pink slip arrived. The homeowner who finds themselves underwater on their mortgage experiences it as a personal crisis, but the lending practices and property valuations that created that outcome were evident years earlier to anyone examining the structural data. What accelerates the current cycle relative to previous episodes is the unprecedented interconnection of global financial markets and the speed at which capital can move. In 1929, it took days for information to propagate and for markets to respond. In 2008, the response time was measured in hours. Today, algorithmic trading systems can execute massive position changes in milliseconds, and the concentration of assets in passive index funds means that selling pressure feeds on itself in ways that were not possible in earlier eras. When the largest exchange-traded funds tracking the S&P 500 experience outflows, they must sell their underlying holdings proportionally, which depresses prices, which triggers more outflows, which creates a self-reinforcing dynamic that human traders cannot counteract quickly enough to prevent cascading declines. The non-bank financial institutions that now dominate sovereign debt markets face similar dynamics. Many of these entities have made their positions on extremely short-term and highly leveraged bases, and their risk models assume continuous access to liquidity that may evaporate precisely when they need it most. The IMF has warned specifically about the growth of non-banks broadening the scope for a scenario in which money market funds make long-term investments but promise customers the ability to withdraw at any time. This is the classic maturity mismatch that has precipitated bank runs throughout financial history, except now it exists outside the regulatory framework designed to manage it. The question of how this affects real people deserves direct attention because economic analysis often proceeds in abstraction from human consequences. When the World Bank notes that at the end of 2025, nearly all advanced economies enjoyed per capita incomes exceeding their 2019 levels, but about 1 in 4 developing economies had lower per capita incomes. It is describing a distribution of outcomes that has concentrated pain in the populations least equipped to absorb it. When the IMF projects that per capita income growth in developing economies will remain about a percentage point below its historical average, it is describing a shortfall that translates directly into reduced life expectancy, diminished educational attainment, and increased childhood mortality in the world's poorest nations. These are not abstractions. They are consequences that flow mathematically from the structural conditions now in place. In developed economies, the transmission mechanisms are different but no less real. When federal debt outstanding eclipses the size of the economy, as it is projected to do in the United States in 2026 for the first time since World War II, the choices available to policymakers narrow in ways that constrain their ability to respond to future shocks. Every dollar spent on interest payments is a dollar unavailable for infrastructure, education, healthcare, or the social safety net programs that buffer ordinary Americans from economic volatility. The Congressional Budget Office reflects this dynamic in its modeling, estimating that growth can be increased by about 1/10 of a percentage point simply by stabilizing the debt to GDP ratio. Conversely, failure to stabilize that ratio implies foregone growth that compounds over time, making future generations poorer than they otherwise would be. The objection often raised to this analysis is that the United States possesses unique advantages that exempt it from the fiscal constraints facing other nations. The dollar's status as the world's reserve currency, the depth and liquidity of Treasury markets, and the Federal Reserve's ability to act as lender of last resort all provide buffers that smaller economies lack. This is true, but increasingly less so. The shift of foreign central bank reserves from treasuries to gold represents a measurable erosion of confidence in dollar-denominated assets. The behavior of foreign buyers moving from long-term bonds to short-term bills indicates that even those who continue to hold treasuries are treating them differently than they once did. The bond market, as one economist put it, is becoming the new king in the United States, with investors gaining significant influence over the rest of the economy in ways that reduce the Federal Reserve's freedom of action. The concept that captures this dynamic is fiscal dominance, a state in which the accumulation of public debt becomes so large that monetary policy loses its independence. In conditions of fiscal dominance, The central bank cannot raise interest rates to combat inflation without triggering unsustainable increases in debt servicing costs, which forces it to accommodate inflationary pressures rather than fighting them. The result is a gradual erosion of purchasing power that economists describe as financial repression, a form of invisible taxation that transfers wealth from savers to borrowers and from citizens to government. This is the modern equivalent of the Roman practice of debasing currency, accomplished not through shaving coins, but through the more sophisticated mechanism of tolerating inflation above target, while keeping nominal interest rates below the rate of price increases. The historical record of nations that cross the threshold into fiscal dominance is not encouraging. Japan has managed the condition for decades through a combination of domestic savings, current account surpluses, and a cultural tolerance for deflation that may not translate to American circumstances. European nations that faced similar pressures in the post-war period experienced varying degrees of inflation, currency devaluation, and political instability. The countries that navigated most successfully were those that undertook structural reforms early, before the constraints became binding. The countries that delayed faced progressively worse options until eventually they had no good choices remaining. The systemic convergence now underway involves the simultaneous approach of multiple stress points. American debt dynamics are approaching conditions that limit policy flexibility at precisely the moment when a Chinese slowdown threatens to remove one of the engines of global growth. Asset valuations are stretched to levels that historically preceded corrections, at precisely the moment when the marginal buyers are leveraged institutions with hair-trigger risk management protocols. Trade tensions have not resolved, but rather paused, with tariff policies creating uncertainty that depresses investment without providing the stable framework that businesses need for long-term planning. The IMF's language about prolonged uncertainty, more protectionism, and labor supply shocks reducing growth is diplomatic shorthand for a convergence of factors that history suggests do not resolve themselves gently. None of this constitutes a prediction with a date attached. Economic systems are complex enough that the precise timing of breakdowns cannot be forecast. What can be identified with confidence is the trajectory, the direction in which current policies and conditions are carrying the global economy. That trajectory points toward outcomes that most participants would prefer to avoid, but that become increasingly difficult to escape the longer corrective action is delayed. The IMF's downside risks are not speculative. They are mathematical consequences of accumulated imbalances that continue to grow. The World Bank's warning about the weakest decade since the 1960s is not pessimism, but observation. The stretched valuations, the debt dynamics, the Chinese contraction, and the concentration of market risk are not opinions, but measurements. The question that remains is not whether adjustment will occur, but how it will manifest and who will bear its costs. Historically, the answer has been that those with the least financial resilience bear the greatest burden, while those with diversified holdings and access to information can position themselves to weather the transition. This is not a recommendation, but an observation drawn from every major financial disruption of the past century. The families who lost everything in 1929 were not the investment bankers, but the ordinary citizens who had put their savings into stocks at the top. The communities devastated in 2008 were not the hedge fund managers, but the homeowners who had been encouraged to borrow beyond their means. The pattern repeats because the structure of financial systems concentrates gains during expansions and distributes losses during contractions. What the January 2026 IMF report reveals, beneath its measured language and conservative projections, is a global economy operating without margin for error at a moment when multiple sources of error are actively threatening. The 3.1% growth figure is not a sign of stability, but a description of an economy growing too slowly to outrun its obligations, while simultaneously too fragile to tolerate the disruptions that faster growth would require. This is the definition of a system approaching phase transition, the threshold beyond which small perturbations can trigger large reorganizations. Whether that transition occurs in 2026 or 2027 or some year beyond is less important than the recognition that the conditions making it inevitable are already in place. The institutional language of downside risks and fiscal vulnerabilities and financial market corrections serves a purpose, which is to communicate concern without triggering panic. But for those who understand how to read such language, the message is clear enough. The architects of the global financial order are signaling that they see what is coming and lack the tools to prevent it. The numbers they publish are not predictions but warnings, offered in the hope that policymakers will respond with the urgency the situation demands. History suggests that such warnings are rarely heeded until after the events they describe have occurred. The Roman emperors who debased their currency understood that they were trading short-term stability for long-term collapse. They did it anyway because the alternative, which required painful choices in the present, was politically impossible. The modern equivalent unfolds daily in capitals around the world as governments choose expedience over sustainability and hope that the consequences will fall on someone else's watch. The mathematics of debt and growth and demography suggest that watch is ending. Claude is AI and can make mistakes. Please double-check cited sources.